Namaskar. This is Akhilesh Bhargav. Welcome to Tit-Bits on Business and Finance with me. With the deadly second COVID wave having subsided and the state governments unlocking their states to some extent or the other, there has been a state-wise resumption of economic activity in some form or the other. Of course, with a varying degree of momentum that we see across different states. The brokerage firm Nomura reports that the business activity in India witnessed a gradual V-shaped recovery in June, as it says, after the low that we saw in May 2021. Nomura says that high-frequency indicators such as mobility indices and power consumption continue to rise, and that as per the first batch of conventional monthly data received for June 21, there is a gradual V-shaped recovery after the bottom that our economy hit in the previous month. Nomura, however, said that the third wave of COVID-19 remains a key risk to economic recovery, which risk can accelerate and balloon due to the slowing pace of vaccination and increased social mobility that we have seen in July 2021. A recent report of the Reserve Bank also discusses the state of the Indian economy. It says that with the fall in COVID cases and an aggressive vaccination drive across the country, the near-term economic growth prospects in India have brightened. The RBI report says that with the COVID cases tapering off, but a third wave looming on the horizon, the state governments have cautiously reopened their state economies, giving what it calls a boost to economic activity in the country. In recent times, according to us, the Reserve Bank has gathered an image of playing down the extent of economic crisis, which we have seen in it overestimating the GDP growth rate of India and it underestimating the bad loans of banks, the NPA crisis of banks to a large measure. Let us review the data points on the state of the economy in the Reserve Bank report and their relevance to the prevailing ground reality, their connection with the prevailing ground reality as we see and we experience it. The general trends that the Reserve Bank notes are a rise in the mobility indicators and attendance at the workplace. It notes a jump in advance tax collections. It notes an increase in power consumption. It notes an increase in digital transactions and other factors in the month of June 21. And on that basis, it points out to a revival in business and consumer confidence in India. The Reserve Bank, however, concedes that a solid increase in demand may take some time, even if we grow at the rate of 9.5% in the current financial year. The RBI then cites an UNCTAD 2021 report to say that India became the fifth largest recipient of FDI in 2020. FDI inflows, according to it, continue to rise in 2021, having touched 32 billion by May 2021. It expects that the flagship Atmanirbhar Bharat PLI scheme will prove to be a game changer and it will attract export-oriented manufacturing investments, which will lead to a rebound of FDI into India's manufacturing sector. To further emphasize India being a preferred investment destination, the Reserve Bank says that India emerged as the third largest recipient of FPI in emerging markets after China and Brazil, and that India's domestic stock markets witnessed record rallies in financial year 21. The market value of the equity holdings of the FPI investors, the foreign portfolio investors, touched a record 612 billion in June 21. This was further reflected in the fact that the Indian stock market saw the fastest growth worldwide in market cap in financial year 21. It then says that the employment situation has been improving and India's unemployment rate has been falling since the past 2 months. The RBI then says that the financial position of the government has improved with buoyant tax revenues due to the increased compliance, and thus the gross fiscal deficit of the government has also fallen. It says that India's merchandise exports have been growing, having crossed monthly exports of $30 billion for the fourth consecutive month in June 21. It points out that forest reserves touched an all-time high of $610 billion, equivalent to about 18 months of imports in financial year 21. On the flip side, the Reserve Bank says that there has been a rise in inflation due to supply side disruptions caused by the pandemic and the hardening of commodity prices in international markets. It points out that retail CPI inflation is at 6.24% in June, which is way above the Reserve Bank's upper tolerance limit of 6%, and it continues to remain so. Petrol and diesel prices have touched record high, it says, as also have been prices of LPG. They've risen sharply. It says that due to the second COVID wave, the manufacturing activity suffered a contraction in India for the first time in 11 months, of which manufacturing output and new orders lost the most. The services sector, according to it, fared no better and contracted for the second consecutive months due to a subdued demand and business closures during the second wave. And finally, the RBI points out that the agriculture sector remains buoyant due to the revival of monsoon. The Reserve Bank report, according to us, gives a reading of the current state of the Indian economy to indicate a revival. But in doing so, it fails to read and report what is most relevant in these times of an economic crisis. It does speak of the risks to revival, but it overlooks certain key and critical economic data and parameters, which to us indicate the real state of the economy and its prospects. The fact of the matter is that with a third COVID wave being imminent and looming on the horizon, it is a very fluid and uncertain state of the economy at present. It is too early in the day to predict a durable revival of the economy, and most nations have failed in doing so. It is what we call a wait and watch situation. The question is, what are the significant parameters to watch with specific reference to the Indian context? To us, these critical parameters are different from what the RBI has tried to note. The first parameter to us is that fresh project investments in the economy, which bring with them much needed jobs, business for the ancillary MSME and service sector, and additional sources of tax collection for the government and build overall demand, is a very important factor to watch. With average capacity utilization in India being below 70% and domestic demand having eroded, such investments and the growth that they get are still far away, and the Reserve Bank does not talk about it. These investments at present are at a 2-decade low, explaining the actual state and mood of the Indian economy according to us. The second issue, an increase in consumer spending may sound like one single figure, but it is indicative of the overall health of the economy by including or encompassing in it multiple factors like rising jobs and income, because unless they don't rise, spending does not go up. It indicates robust household sector savings. It indicates rising consumer confidence and a rising bank credit. After all, as a general rule, an economy that spends is an economy that grows, and that is the key missing element in the Indian economy at present, which the RBI report is silent about. Further, it is still too early to say whether the rise in high-speed indicators in June 21, which the Reserve Bank talks about, are the start of a durable growth or are merely the pent-up demand spending which we see whenever a lockdown takes place and opens up. And that is what we saw in Q3 and Q4 of financial year 21. It just fizzles out. With no major improvement in the overall growth, to us, this pickup in the economic activity looks like the pent-up demand of the lockdown months of April and May 21, which will not sustain in the coming quarters. Keep your fingers crossed, since it is too early in the day to conclude a revival on the basis of a single month data which the RBI has been trying to analyze. Yet another key parameter to watch about the state of the economy and its revival is the buildup of NPAs and the rising defaults. They are all around and they are rising, and they show a disturbing financial condition of the banks and their borrowers. Even the incidence of check bouncing in India has gone up sharply, showing how fragile the financial position of business and households is. This needs to be carefully watched. And finally, the Reserve Bank talks about the rising tax collections and an improved state of government finances. Then, why is the public being tormented by the constant increase in petrol, diesel and LPG prices? And if the government coffers have improved, then Why not a genuine fiscal stimulus package for the suffering sectors of the economy has been announced by the government of India? And if the FDI has been going up, then why are the numbers not reflected in the investments in fresh projects which remain at a multi-decade low and don't seem to revive? Further, the record foreign money in Indian stock markets is nothing to gloat over. It is just speculative surplus global funds sloshing around in our markets, which have created a dangerous artificial boom, where it is the ordinary Indian investor who will suffer the maximum losses when such hot money suddenly flows out of their country without any notice. The record stock market rallies with no solid fundamentals are a mere irrational exuberance and are nothing to be proud about, as the Reserve Bank seems to be. And finally, the record forex reserves of $610 billion are not truly impressive when we consider the fact that India's external debt stands at about $565 billion and the market value of the FPI investments is $612 billion, which can be sold and the money has to be remitted out of India. And of course, let us not forget the essential monthly imports that need to be done and need to be paid in foreign currency. So it's not something so large to talk about, even though it may be a record forex holding of the government. The pandemic has not gone away, and a third wave seems to be on the way, which everyone agrees. After each lockdown comes a month of pent-up demand, as we are seeing now, and that cannot be the benchmark to judge the state of the economy, as the likes of Reserve Bank of India and Nomura have done. It is, as we said, time to wait and watch. But we must watch the correct parameters that tell the complete truth and not mere portions of it. And let not authorities like Reserve Bank of India certainly not be in a hurry to come up with projections, to come up with estimates, or to come up with reading of the economy, which we think do not truly indicate the complete and correct parameters. This is Akhilesh Bhargav signing off till we meet again. Namaskar.